If you have $1,000 ready to invest but no idea where to put it, that's understandable because the options are overwhelming. And following advice online from so-called money gurus who are just trying to sell you a course or a BS meme coin is an easy way to turn $1,000 into zero. So here's exactly where to invest and what you should actually invest in. But just because you have $1,000 ready to go right now doesn't always mean you should invest it. If you don't have 6 months of living expenses saved up, your $1,000 shouldn't be going into the market. Say you invested today and 3 months from now you lose your job. Now you have nothing saved and your rent is due. So you pull any money you have from your investment account just to afford living. Except now you're selling at whatever price the market's at, whether you like it or not, paying taxes on your gains, and potentially getting hit with early withdrawal penalties depending on the account you used. So 6 months of expenses in a high-yield savings account is what keeps your investments invested. Because without it, one bad month destroys everything you've built. And the same idea applies to high-interest debt. If you're carrying credit card debt at a 24% interest rate while your investments are returning 7% a year, you're not making a profit. Every dollar you put into the market while your debt grows costs you more than it earns. If those two are handled, then you're ready to go, and if they're not, that's what the $1,000 tackles first. So once you're ready to invest, the first question is, where do you do it? The 3 investing platforms you'll see recommended everywhere are Vanguard, Fidelity, and Schwab. They're all legitimate, but for someone starting with exactly $1,000, one of them makes more sense than the others. Vanguard's most popular index funds, which we'll talk more about later, require a minimum investment of $3,000. So with $1,000, you can't even access some of their best funds. Schwab and Fidelity don't have that problem, but Fidelity has a specific advantage for someone starting with exactly $1,000. Some investments I will recommend in a minute trade at $300 or $400 per share, and if you can only buy full shares, part of your $1,000 never gets invested. Luckily, Fidelity lets you buy fractional shares, which means that every dollar can be fully invested into anything you like. They also charge some of the lowest fees of any platform out there, and NerdWallet has ranked them as the #1 platform for beginner investors since 2022. So open up a Fidelity account. This will take you about 10 minutes. Now, inside Fidelity, you can open up a few different types of investment accounts. And the one you choose determines how much of your returns you actually keep after taxes. The best retirement account to open on Fidelity is called a Roth IRA. You contribute money you've already paid taxes on, and everything that money earns grows completely tax-free. So when you withdraw it in retirement, you pay nothing. For 2026, you can contribute up to $7,500 a year, and as long as you're earning under $153,000 as a single filer, you're eligible for the full amount. And if you want access to this money before retirement age or you're over the income limit, a taxable brokerage account is your other option. You'll pay long-term capital gains tax on profits if you hold your investments for more than a year, but there are no restrictions on when you can take it out. If you want to keep all the returns you make, put the $1,000 into a Roth IRA because the account your money sits in can dictate your long-term returns more than the investments themselves. The other thing that costs investors more than bad fund picking is panic selling. When your balance drops, the instinct is to sell before it gets worse, but you haven't technically lost anything until you sell. A market drop just means the assets you own can now be repurchased by you for a lower price. And the real gains aren't made when you buy at the top, it's when you buy at the bottom. So instead of panic selling, keep investing. But the most overlooked aspect of investing is fees. Some investment funds charge 1% of your total balance every year. And because your balance compounds, that fee grows with it. So the only funds we're about to cover charge anywhere between 0.02% and 0.12%. Now, when you first open Fidelity, one of the options available is individual stocks. You can own a part of Apple or Nvidia or whatever company you believe in 2 minutes. And that sounds like a solid strategy. If you know the product and you trust the brand, then you might as well own a piece of what it's building. But putting your $1,000 into one company means everything depends on that one company doing well. A bad earnings report, a CEO scandal, a competitor releasing a better product, any of those can wipe out a large part of your investments with no warning. And the data on stock picking is brutal. Over a 15-year period, roughly 89% of actively managed funds, which is where professional investors pick individual stocks and package them together, still underperformed a passively managed fund that tracks the market automatically. These are professionals whose entire job is to beat the market, and even they can't do it. Warren Buffett is widely considered the greatest investor in history. He's the person behind Berkshire Hathaway, which is one of the most successful investment companies ever built. But in a letter to his shareholders, he wrote that the money he leaves behind should go into a simple, low-cost index fund. So what is an index fund, and which one should you invest in? Index funds are a way of investing in an entire market at once instead of betting on a single company. You're buying a small piece of every company in that market simultaneously, so if one drops, the others are there to hold it up. And if the market grows, then your investments grow with it. On Fidelity, 4 index funds are worth knowing. The first is the S&P 500, which is what Warren Buffett recommends. The S&P 500 tracks the 500 largest companies in the United States. That's including Apple, Microsoft, Nvidia, Amazon, or basically the biggest names in the country. Fidelity's S&P 500 mutual fund, labeled FXAIX, charges 0.02% of your balance per year as a management fee. For context, that's the lowest expense ratio of any S&P 500 fund available anywhere. Then there's the total stock market. So instead of 500 companies, you own a piece of roughly 3,600, including mid-size and smaller companies that aren't yet in the top 500. And VTI, the total stock market fund, charges 0.03% annually. But the top 500 companies already make up about 84% of the stock market by weight, so the two are nearly the same fund, and there's really no reason to hold both. Then VXUS, the Total International Stock Fund, covers companies outside the United States like Europe, Asia, and emerging markets for a fee of 0.05% a year. The US isn't always the best performing market globally, and international exposure means your returns aren't entirely tied to one economy. And for bonds, there's BND, the Total Bond Market Fund, costing 0.03% a year. Bonds are loans you give to governments or companies in exchange for regular interest payments. They're more stable than stocks, but the trade-off is slower growth. Now we know which funds are worth knowing, but how much of each should you actually hold? For a younger investor starting out, you probably don't need to split your $1,000 across multiple funds right away. Diversification does reduce risk, but when you're in your 20s, time is your biggest asset, and spreading your investments across too many funds too early means you're optimizing for stability instead of growth. And the math just doesn't support doing that yet. So pick from the S&P 500, total stock market, and international stock market for now. And historically, the US stock market performs better than international, so if you do add international, I wouldn't make it 100%. As you get older, your timeline will shrink and a mix of stocks and bonds will start making more sense. But that decision comes later, and if you'd rather not think about that at all, Fidelity has a fund that handles it automatically. They're called Freedom Index Funds. You pick the one with the year closest to when you plan to retire, and the fund shifts from stocks to bonds as you age. The cost is 0.12% a year, which is more than the other funds, but this fund is managing your allocation for you across decades. And for someone who wants to set it and forget it without having to rebalance all over again, that's a reasonable trade-off. And this first $1,000 is doing something more important than generating a return. It proves that you can put money to work and leave it alone. An investor who does that, who starts with $1,000, sets up the right account, and adds, let's say, $200 a month for 30 years at a 7% annual return, ends up with over $240,000. But the returns from the initial $1,000 investment are almost irrelevant compared to what came after it. What really builds that number is holding through every drop and contributing every month even when the market is down and it feels like the wrong time to put money in. Over 30 years though, that consistency is what compounding is actually made of. And the $1,000 is how you start building it. Thank you my friends for watching, and I'll see you next time.